How are non-cash assets valued for gift tax rules? Imagine giving a piece of art or a property to a loved one and wondering how much it's really worth for tax purposes. When it comes to non-cash gifts, figuring out their value can seem tricky. But understanding how the government measures this is key to managing your wealth transfer plans. Non-cash assets are valued based on their fair market value at the time of the gift. Fair market value is the price a willing buyer and a willing seller agree on, with neither feeling pressured to buy or sell. This means the value reflects what the asset would fetch in an open market. For assets like stocks traded on public exchanges, this is simple because market prices are readily available. However, for assets like real estate, privately held businesses, artwork, or collectibles, determining fair market value is more involved. Usually, a qualified appraiser is needed to give an accurate estimate. They look at comparable sales, the income the asset might generate, its condition, and current market trends. This detailed report helps establish a reliable value for tax purposes. The IRS has specific rules about when an appraisal is necessary. If a gift exceeds the annual exclusion amount, which is $19,000 per person in 2025, you need to report it on a gift tax return. While an appraisal isn't always required for gifts just over this limit, it becomes important if the value approaches or exceeds the lifetime exemption limit, which is about $13,990,000 in 2025. For high-value or complex assets like businesses or real estate, the IRS often scrutinizes the valuation closely. Having a professional appraisal helps justify the fair market value and prevents issues if the IRS questions the amount. The appraisal must be performed by a qualified appraiser who provides a detailed report. This report should include how they arrived at the value, such as comparable sales or income analysis, and any assumptions made. Accurately valuing non-cash gifts is vital for estate planning and transferring wealth across generations. Proper valuation ensures you stay compliant with tax laws, avoid penalties, and preserve your legacy. It also helps you make strategic gifting decisions, like using the annual exclusion or the lifetime exemption without unexpected tax surprises. In summary, to value non-cash assets for gift tax rules, you determine their fair market value at the time of the gift. For complex or high-value assets, a professional appraisal is usually necessary. Always report gifts exceeding the annual exclusion on the proper tax forms and keep detailed documentation of the valuation. Remember, this careful approach supports your goal of long-term financial security and a lasting legacy.